Okay, let's get some more on the mood of the markets. Lesley Marks, Chief Investment Officer of Equities at Mackenzie Investments, joining us here in studio. Lesley, great to see you.
Great to be here once again, John.
What's your assessment of what's been happening so far in January?
Well, I think when you look at markets, we've really been trading sideways. And all things considered, given the strong run that we had in the last 2 months of the year, that's a pretty good outcome. I think that we would have expected to see a little bit of a pullback after such a strong run in everything.
And on this interest rate stuff, how deeply are you diving into it? I mean, it seems to me it's just that the first card on the table is whether or not we're going to see interest rate cuts, call it in the first quarter of 2024. Not that we're not going to see rate cuts, but just that there's enough on the inflation and economic front to justify holding rates steady for now.
I think what's happening is people are really reading a lot into every piece of economic data to try and thread the needle and time it just right. And, that's just not how most people invest. It's certainly not how we think about investing. So whether or not the Fed cuts in March or April, or the Bank of Canada in April or June, ECB, it's happening somewhere between the end of the first quarter and probably the end of the second quarter globally around the world. And I think the trend is in place, that rates have peaked, central bank rates have peaked, and the next move is down. So I don't want to give too much weight to the day-to-day economic data.
And then in terms of the actual investing landscape for the year, what do you see in front of you? Is there opportunity? Do you think there's a reason to be generally upbeat on, say, stock market investing this year?
Well, I think that the most important thing is to think about that last 2-month rally was really a multiple expansion-driven rally because of the outlook for lower interest rates. The next part of the rally that I think we need to support equities is the earnings piece. Earnings expectations for this year in Canada are about 7 to 8% growth. In the U.S., they're about 11%. They may be a little bit high, so let's say they're in that they come in the 5 to 8% range, and then you've got the dividend yield. You're looking at mid to high single-digit returns for the year. So another reasonable average year after what was really an above-average year in 2023.
Yeah, and I mean, those who are a little bit more pessimistic have been saying they think those profit expectations are going to come down, and that's a reason to be cautious. I guess, what's the alternative? If there is earnings growth, but it's not what some would expect, what happens? Does that mean investors move away from the stock market, or does it mean they just sort of fine-tune the way they're investing in the stock market?
Well, I think there's two things to think about. One is it's very normal that at the beginning of the year, earnings expectations are at their peak. So it's a matter of how much earnings come down. Last year was a flat year in earnings, 0 earnings growth, and yet we had massive moves in equities. So we want to be really cautious about putting too much into this earnings outlook question. I think the real issue is the central bankers are trying to figure out the battle between inflation and the economy. And we've had a lot of signs that show, certainly here in Canada, the economy has been slowing for the last 6 or 7 months. We're not seeing the same signals in the U.S. It's certainly come off of the strength that we saw in the summer. But this morning, we saw very strong retail sales. So the consumer continues to hold the U.S. economy up, less so here in Canada.
So for equity investors, how are you thinking about 2024? Like, what's the sector strategy that you're embarking on?
So I still think that because timing of rate cuts is somewhere in the next couple of months, or next, call it 3 to 6 months, that creates a little bit of uncertainty for markets because we've priced in so much optimism around rate cuts. And so the way I would look at investing is thinking about safety. You've just come off a really big year. We still think that equity returns will be fairly good this year, but look at things that have less economic sensitivity, and that's where the safety trade really comes into play. So not really sector specific, but different trends. So thinking about things like where there's a secular tailwind, sectors or subsectors in the technology space, for example. Consumer sectors might be a little more vulnerable to a slowing economy. What we don't know is if central bankers get behind the curve here, because right now, real rates based on where interest rates are and inflation are pretty high and could have a very strong slowing impact on the economy.
So it's interesting hearing you say that because I'm looking at the TSX sector performance. It's still early, but overall the benchmark in Canada is a little flat to negative. But you've seen, call it a safety group, communication services, so those would be some of the telcos, has done relatively well. But as you know, there's still an appetite for some of the technology companies. Energy as a group is higher this year, but we mentioned that oil prices are down today. And at the end of the day, the Canadian market is still quite skewed towards the commodity sectors. And we saw the hit that the TSX took yesterday just because of what's happening in oil and gold and beyond. So how do you think about commodity performance vis-a-vis sort of your equity investing strategy?
So the commodity market is really interesting right now because if you look through at some of the more cyclical commodities, oil, copper, for example. And I should qualify that in Canada, part of the driver is natural gas. And the markets have been a bit frigid, but so have the temperatures outside, right? So you have, we've had a bit of a move in natural gas that's gone a bit contrary to oil prices, which have come down. So the economic impact that seems to be, finding its way through commodities like copper and oil is indicating the expectation that the global economy is going to slow this year. So that's really important, particularly for Canada, because our overall stock market is much more a play on the global economy, including the Canadian dollar. When people feel more optimistic about the future, if you will, risk on, that's very good for the Canadian dollar in general, and people start selling the safety currency, which is the US dollar. So I think the economy, the global economy, is going to be the big factor that impacts Canadian stocks. Not to say that there won't be opportunities here in Canada. You mentioned the telecom sector. I mean, that's a sector that was very hard hit, high yielding sector in 2023, very much impacted by high interest rates. Now you're seeing sort of the reversal of that trend in that sector, which had been probably significantly oversold.
Okay.